There are 878,000 American homeowners right now who are either severely delinquent or already in foreclosure, and almost nobody is connecting what's actually causing it. The headline you've been hearing is that the market is stable, delinquencies at 3.68%, historic lows. That headline is a lie by omission. Because underneath that 3.68% headline, a very different story is unfolding. Intercontinental Exchange, one of the largest mortgage data companies in the country, just confirmed that 878,000 number is the most we've seen since June of 2018. The Mortgage Bankers Association just reported that FHA delinquencies hit 11.52%, the highest level since 2011. Bank repossessions just surged 45% year over year in a single quarter. And the Wall Street Journal just dropped a bombshell. More than 1 in 4 FHA loans originated by America's largest home builder in the past 3 years is already underwater, meaning the homeowner owes more on the mortgage than the property is now worth. And here's the part that should be getting a lot more attention than it is. In the 2008 cycle, this exact same signal flashed 6 to 9 quarters before the conventional mortgage market collapsed. The canary died first, and Wall Street knew before Main Street did. That's happening right now, again. So this is not a national crash. This is a two-track crash. Track 1, people who bought before 2021, locked in low rates, sitting on real equity, they're fine. Track 2, recent buyers, FHA borrowers, people in specific Sunbelt cities, they're already falling off a cliff. And the cruel part is, if you're on track 2, nobody's telling you until it's too late to do anything about it. So here's what I'm about to show you, and I want you to stay with me on this to the end, because the last data point I'm going to share is the one that changes how you should be thinking about your own home right now. I'm going to name the specific cities where foreclosure rates and underwater numbers are already rivaling the worst of 2008. I'm going to show you what Wall Street's largest landlords are quietly doing this quarter. And I'm going to get to the one hidden cost, not your mortgage, not your taxes, something else entirely that is now pushing even prime borrowers with 780 credit scores into default. If you own a home, if you're trying to buy one, or if you're trying to sell one right now, you need to see this. Let's start with the one number that has the people who actually move this market. The institutional analysts. More nervous than anything else we've seen in the last 3 years. And I want you to understand why it matters, even if you don't have an FHA loan. FHA is the primary mortgage product for first-time buyers, for lower-income buyers, for people with smaller down payments. So when FHA breaks, it's breaking on the most financially fragile slice of the market first. And that 11.52% delinquency rate, it jumped 106 basis points in a single quarter. Just to be clear about what that means, that's not a slow drift, that's a tremor. And if you know how tremors work, you know what comes next. But the delinquency rate alone isn't what has us paying attention. It's who's actually defaulting. Intercontinental Exchange data shows that FHA loans now account for more than 80% of the recent rise in severely past due mortgages. Here's how to think about that. FHA is less than 15% of all active mortgages in this country, but 38% of all active foreclosures, less than 15% of the loans, 38% of the foreclosures. And the cure rate, meaning how many delinquent FHA borrowers actually manage to get current again before they lose the house, has collapsed by roughly 70% since last fall. Translation, once these people fall behind now, most of them aren't coming back. Here's why we're making such a big deal out of this. If you lived through 2008, or if you've studied it, you know that the crash didn't start with prime conventional borrowers. It started at the bottom of the market and worked its way up. FHA and VA delinquencies rose 6 to 9 quarters before conventional loans followed. That was the warning shot. And right now, the gap between FHA delinquencies at 11.52% and conventional at 2.89% is the widest we've seen in modern mortgage history. That's not a normal divergence. That's the canary falling off the perch again. But FHA isn't the only canary. There's another wave building that almost nobody is talking about: adjustable rate mortgage resets. If you took out an ARM back in 2015 or 16, you locked in a rate somewhere around 3%. That rate was fixed for the first 10 years. Well, that 10-year window just closed. Those loans are adjusting right now, and they're not adjusting to 3.5% or 4%. They're adjusting to 7%, sometimes 8%, depending on the cap structure of the original loan. On a $400,000 mortgage, that's the difference between a $1,700 payment and a $2,700 payment, $1,000 a month overnight. Mortgage Bankers Association data shows hundreds of thousands of ARM borrowers have already passed their initial fixed rate period and are actively adjusting into this higher rate environment. And here's what makes this worse. New ARM originations just hit 12.9% of all mortgage applications. That is the highest level since 2008. A lot of people taking out ARMs today aren't doing it because they want to. They're doing it because it's the only way they can afford the payment. That's not confidence. That's desperation dressed up as a mortgage product. So that's the loan type story. But here's what almost no other housing channel is going to tell you. And we're going to say something that's going to upset some people in the Florida real estate industry because the data is the data. If you own in these specific Florida metros right now, you're in the worst housing position in America. Lakeland, Florida has the worst foreclosure rate in any metro over 200,000 people. 1 in every 409 housing units. Punta Gorda, Florida is 1 in 416. Cape Coral has a foreclosure rate ranked second in the entire country. And here's the part that should concern you if you own property in any of these markets. Lakeland also has the highest underwater rate in the country. 10.8% of mortgaged homes are upside down. In Cape Coral, it's 10.1%. Austin, Texas, which people were calling the hottest housing market in America just 3 years ago, is now at 9.2% underwater. And before you tune out because you don't live in any of these cities, stay with us because where these cities go, the rest of the country follows within 18 months. That's the historical pattern. And this is where the home builder piece clicks into place. The Wall Street Journal reported back in November that more than 1 in every 4 FHA loans originated by Lennar Mortgage between 2022 and 24 is now underwater. In Cape Coral specifically, over 1/3 of those 2023 and 24 vintage loans are upside down. And the American Enterprise Institute pulled the string further. They found that 64% of homes sold by America's largest home builders included permanent mortgage rate buydowns, deals that made the monthly payment look affordable but inflated the sale price and quietly buried how much the seller was really conceding. Those buyers didn't know it at the time, but they bought at a manufactured price that was already starting to correct the day they got the keys. And we want you to really hear this next part because it cuts right to the title of this video. If you're one of those 2022, 23, or 24 buyers in a Sunbelt metro and you used an FHA loan and you're sitting in a property worth less than you owe, you are the specific homeowner this video is about. Not because you did anything wrong. You trusted the process. You trusted the builder. You trusted the numbers you were shown. But the structure of that deal was working against you the day you signed the paperwork. That's not us being dramatic. That's what the data is telling us right now. Real quick, if you're getting value from this and you want more of these breakdowns before everyone else catches on, hit subscribe and the notification bell. We do these every week with real institutional data. No fear-mongering, no fluff. And if you're already subscribed, do us one more favor. Drop a comment with the cities you're watching from, because we track which markets our audience is in and it shapes what we cover next. All right, let's keep going. Remember at the start when I said Wall Street was doing something quietly this quarter that tells you exactly where the market is heading? Here it is. Blackstone, the largest real estate investor on planet Earth, has cut its single-family home purchases by more than 90% since 2022. 90%. The smartest money in the country has almost entirely stopped buying American houses, and nobody is on the news asking why. Invitation Homes, one of the largest single-family landlords in the country, bought 0 homes off the MLS in the fourth quarter of 2025. 0. Every single acquisition they made came directly from builders trying to unload inventory. And their 2026 guidance calls for $550 million in planned home sales. Their peer, American Homes for Rent, sold over 1,800 homes directly to individual homeowners last year, unlocked 20,000 previously encumbered homes from securitizations, and is guiding to another $400 to $600 million in sales this year. Data from Parcel Labs confirms what's happening on the ground. In Atlanta, institutional investors are now selling roughly 2 homes for every 1 they buy. In Dallas, they own about 9% of the housing stock, but they make up 23% of new for sale listings. 6 specific metros are absorbing most of the institutional selling: Atlanta, Phoenix, Dallas, Houston, Tampa, and Charlotte. And the inventory numbers in those markets are going vertical. Charlotte is up 38% year over year. Dallas up almost 38%. Atlanta up 34%. Phoenix up 27%. Jason Lewis, the co-founder of Parcel Labs, put it to CNBC this way. Folks are trying to take risk off the table. Rents aren't holding up relative to what investors can earn just by selling the asset. The risk-adjusted return favors cash, not holding real estate. When the biggest, most data-rich players in this country all move in the same direction at the same time, that's not a coincidence. That's Wall Street telling us something out loud. They see something the average homeowner doesn't see yet. And here's the part that nobody wants to say out loud. When institutional money exists first and retail catches on second, retail is always the one left holding the bag. Every single time. That's how it worked in 2000. That's how it worked in 2008. That's how it's working right now. Okay, this is the part of the video I told you to stay for because so far I've shown you who's defaulting and where. But I still haven't told you why. And once I show you why, you're going to see your own insurance renewal differently. Because on the surface, none of this should be happening. A homeowner with a 780 credit score doesn't just start missing payments. Their mortgage didn't change. Their income didn't collapse. So what gives? This is the single data point from Intercontinental Exchange that reframes everything I just told you. Homeowners in the top fifth of insurance costs nationally are now past due on their mortgage at a rate of 7.6%. Homeowners in the bottom fifth, only 2.9%, more than double the default risk, purely based on what they're paying for insurance. That's the hidden cost, not the mortgage, not the property taxes, insurance. And the insurance numbers are ugly. Premiums are up 46% since 2021, 3 times the pace of general inflation. The national average is about to cross $3,000 a year for the first time. In 2025 alone, Colorado homeowners saw premium increases of 33%. Iowa, Nebraska, and Minnesota weren't far behind, all north of 25% in a single year. And those states don't even make the Florida or California conversation. This is just regular America, where the math on home ownership is quietly breaking. California is its own situation. The FAIR Plan, which is the state's insurer of last resort, now covers over 668,000 homeowners. They just requested a 35.8% rate increase, the largest in 7 years. The Palisades and Eaton wildfires alone generated an estimated $4 billion in FAIR Plan losses. Some California homeowners could see premium increases of 300% or more this year. And Florida condo owners? This is the one nobody outside of Florida understands. After the Surfside collapse, the state passed milestone inspection and structural integrity reserve study mandates. The intent was good. The consequences have been catastrophic for certain buildings. The Mediterranean Village in Aventura just hit individual unit owners with special assessments up to $400,000 each. I'll say that again. Single condo units in one building getting $400,000 bills. The Palm Bay Yacht Club in Miami, up to $175,000 per unit. And a lot of the people getting these bills are retirees on fixed incomes who bought their condo 20 years ago. They're watching their retirement evaporate in real time because the building needs a new roof. So when you stack it all up, insurance doubling in 5 years, special assessments hitting 6 figures, property taxes climbing, it's completely possible for a homeowner who's paid their mortgage on time for 15 years to suddenly be choosing between eating and keeping the house. That's the actual engine underneath the default wave. Not reckless borrowing. The total cost of ownership crossed a line that too many American households simply cannot cross. Drop a comment below and tell us which one of these is hitting you the hardest right now. Is it insurance? Is it property taxes? An HOA assessment? We read every single comment. And hearing what's happening in your specific market is honestly how we decide what to cover next. That's what the actual mechanism of default looks like on the ground. Now, let me tell you what to do about it. If you're a homeowner on track 1, you bought before 2021. You locked in a low fixed rate. You've got real equity. Nothing we've said today is a reason to panic. You're in the strongest financial position American homeowners have been in for a generation. Your job right now is patience. The worst thing you can do is get shaken out by headlines and sell into weakness when your equity and your rate are protecting you from almost everything the market is throwing at other people. If you're on track 2, and you know by now whether you are, here's exactly what we need you to do. And we need you to do it this week, not next month. Get honest about your carrying costs today. Pull up the insurance renewal. Pull up the property tax bill. Pull up the HOA reserves if you're in a condo. If you have an ARM, pull up your adjustment schedule and know exactly when the next reset hits. If the math is sliding the wrong way, call your loan servicer before you miss a payment, not after. Loan modifications and payment deferrals are a completely different conversation when you're current than when you're already 60 days late. That collapse in FHA cure rates I showed you, it's happening in part because people wait too long to ask for help. If you're a buyer, this is actually one of the first windows in 5 years where the math is starting to work in your favor. 36% of builders are cutting prices right now. 60% are stacking on incentives. Lennar is spending an average of 14% of sale price in concessions just to move homes. If you're looking at Cape Coral, Austin, Phoenix, Tampa, Dallas, you have more leverage as a buyer than anyone has had since 2019. Don't overpay. Don't accept a builder buy-down without understanding exactly what it's hiding. Get an independent valuation before you sign anything. If you're a seller, the window is narrowing, especially in the Sunbelt. Inventory is climbing. Days on market is climbing. The longer you wait, the more you're going to be competing with both individual sellers and institutional investors, dumping 20 to 30% of their portfolios. Price in front of the curve, not behind it. Let me close with the part I think actually matters most. This is not 2008. Lending standards are tighter. Most existing homeowners are locked into low rates. Overall delinquency is nowhere near the 10% levels we saw in 2010. But what we're in right now is something different, and in some ways more insidious. It's a crash that only hits specific people in specific cities who bought in specific years with specific loan types, which means most of the country will tell you nothing is wrong, right up until it's their neighborhood, their equity, their family. The homeowners who come out ahead are the ones who recognize these signal early, act on their carrying costs honestly, and position themselves for the opportunities that are absolutely going to emerge. That's how every correction in American history has ended. Wealth transferring from the people who weren't paying attention to the people who were. The only question is, which side of that transfer you're going to be on this time. If this breakdown was valuable to you, make sure you're subscribed with the notification bell on, because next week we're breaking down the exact 10 Sunbelt metros where the biggest buyer opportunities are emerging right now. Specific zip codes, specific price cuts, specific builders who are panicking. If you're thinking about buying in the next 12 months, that video is going to save you money. And if you don't want to wait, check out this video right here. We'll see you in the next one.